You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That rocking tune means it is time once again for Options Bootcamp, the program here on Education Wednesday where we break down some of the maybe scary, mystifying, complicated, or just downright off-putting options topics that maybe you, the busy retail stock trader, maybe you've been thinking, maybe I should try them, our options over there, but maybe you couldn't get around to it. Maybe you were a little bit scared, a little bit intimidated. Maybe you just didn't want to tell anybody else that you didn't understand these things. Well, guess what? We don't judge here on the show. You can listen to us whenever you want, and we'll just send the information your way. Of course, speaking of that information flow, if you like what you hear, make sure you go out to your platform of choice, wherever you're listening to this, and make sure you leave those reviews there, so that other folks can continue to discover this program. There's been a huge influx of people over the past 6 or so months. And so, as you can imagine, they need a place to go to learn about options. So if you like what you hear, help keep that flow coming. And then B, send that information back to us. If you have a question or a comment or maybe a topic you'd like us to review here on the show, hit us up. You know where to find us at Options on most of the major social media platforms, theoptionsinsider.com. That also works, of course. Our mobile app out there, you can put it in there as well. Or, of course, questions at theoptionsinsider.com. That works. Smoke signals, once in a while. Carrier pigeons, a little bit less reliable. Keep those questions coming. We do love to hear from you guys. Let's see who we're hearing from on the old program today. I'm pleased to say that I am joined once again by my Options Bootcamp drill instructor cohort here, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of one or two options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Hey, buongiorno, Signor Longo.
Buongiorno indeed. Are you ready to talk some options, sir?
Let's do it. Let's do it.
All right, then. Without further ado, it is time for your basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, prepare to learn.
All right, welcome to Basic Training, the portion of the show where we break down the aforementioned options, concepts, or techniques, or tricks, and attempt to explain how you, the basic retail stock trader, maybe you're new to options, maybe you've been trading options for a little bit, but you want to improve your game. Either way, we got you covered here in Basic Training. And today's topic going to be a little bit different. Not just going to break down, let's say, a covered call or a short put or something like that. Instead, we've seen so many new people discovering the show and indeed discovering options over the course of 2020. It certainly has been a terrible year for just about every other metric. But in terms of people discovering and trading options, it's been a pretty strong year out there. And a lot of them have been coming on these newer retail-oriented outlets like your Robinhoods and your Weebills and others, where they're coming at it and they're pretty much starting from scratch. And so we get these questions a lot, or something along the lines of, hey, where should I really begin with my options trading? Or something along the lines of, thinking about trying out these options, what should I really know before I really get started, before I really start trading these things? We thought that would be a fun little back and forth conversation to have on the show today. So Dan and I have compiled each our lists of the top 5 things you need to know or understand or have some grasp of before you start trading options. Mr. P, does that sound like a plan A? And B, do you have your list, sir?
I've got my list, Mark. I am prepared today, baby.
All right. I think you're going to be embarrassed, though, because my list is just going to smoke yours, sir. Can you handle this? A little bit of back and forth list action?
Oh, we'll see, Mark. We will see.
We shall see. Tell you what, I will be charitable. I will go first. I will set the stage to allow you to just bask in my brilliance for a little bit. How's that sound?
Oh, boy. Now I've heard it all.
All right, let's kick it off. And this is an interesting one because these lists are obviously highly subjective. And so the ordering of them, sometimes I might think this is a little bit higher, this is a little bit lower. This is my snapshot of how I'm feeling right now, listeners. And number 5 is actually probably one I wouldn't have put on my list, let's say 6 months ago. Because it was something that I kind of assumed if you got into this space, you probably had a bit of a grasp of. But we have seen in that intervening 6 or so months the literally tragic consequences of not understanding this particular topic. So I'm kicking off my list at number 5 with the process of how exercise and assignment works, and particularly focusing on some of the more tricky scenarios. Obviously, everyone understands, at least I hope you understand if you get into options, that once you're a penny in the money, you are going to be automatically exercised after the option expires. That's a pretty straightforward thing on the equity options front. It may differ a little bit depending if you're looking at some other things like futures options, things that are outside the realm of OCC. But in general, on most of the things you guys like to trade, the equity and index options, it expires a penny in the money, then you're going to get exercised. That's pretty much just the nature of it. And they reduced that threshold in recent years. It used to be a nickel, and that allowed a little bit too much wiggle room. So now they're down to a penny, so there's pretty much no wiggle room. If you are, by any definition, in the money, your contract will be automatically exercised. And now that seems like a very straightforward thing, but there are some scenarios where things get a little bit more dicey. For example, we saw earlier this year, Dan and I did a whole episode about it, the tragedy of the Robinhood customer who didn't really understand the early exercise portion of that and how that could potentially impact his portfolio. He was selling put spreads, I believe it was, in Amazon, and he was assigned early. So make sure you understand if you're going to put on, so let's say short premium type trades, usually in particular, that's where this starts to get a little bit dicey. What happens, A, if the underlying expires in between the strikes of your spread? That's always a little bit of a dubious area there. People get a little bit confused about that. And B, what happens if you get assigned early on one leg of that? Obviously, you can only be assigned on the short leg of a spread, so that's where you're going to have to focus your attention on. But what happens to that? Does it really have a material impact on your portfolio? Did your risk profile really change, or are you really just seeing this big spooky number that really isn't accurate, as was the case in the Robinhood space? So before you really dive deep into the options waters, I definitely recommend you have a full grasp on how the whole exercise/assignment process works, particularly in some of these stickier scenarios like when the underlying expires between the strikes of a spread that you are short, or perhaps when something is assigned on you early, how that can or perhaps cannot impact the risk of your portfolio. So, Dan, that's my number 5. A, what are your thoughts on that? You have anything to add on that? And then B, what is your number 5, sir?
Well, Mark, let me tell you what here. I only came up with 4.
Once again, Dan not doing the homework.
And I'll give you a little bit of credit, Mark. I'll give you some credit where credit's due. And I didn't think about how exercise and assignment works. And yeah, I'll give you some kudos for that, because you know what? That is extremely important just from like a pure fundamentals standpoint. You got to know the basics of it. and you really want to know the nuances of it, because I remember during the coronavirus crash scenario and subsequent rise scenario, I think this was kind of on the upturn. I had one of our students who had on a position, and what was it? I forget exactly what it was. I think it's some sort of spread or something. And he had a call, I guess it was, that was out of the money, and he just sort of left it, it was out of the money by like kind of a bit, like 40 cents or something. And he actually, or no, he was short it. That's right. He was short a call that was out of the money by about 40 cents. And he actually got assigned and ended up with a short stock position. And he was like, wait, I didn't even know that could happen. And, and it can, like all the stuff that Mark just brought up, super important. Got to know all that. But you also have to know that, like, options are options. They are rights. And the person who owns that right can decide to exercise, even if it seems to you like he shouldn't, even if it's not an automatic no-brainer exercise. Like, people can exercise stuff out of the money. So got to be careful.
All right, charitable fellow that I am, since you didn't do all of your homework, I'll let you cheat and copy mine. So that can also be your number 5 as well. How's that sound, Dan?
That sounds good. Let's see. Did you hit all? I don't know if you didn't hit all the ones on my list. Should I go through with the rest of my list?
Let's just do one at a time, because we want to compare and contrast lists. So that's your number 5. You can go next. What is your number 4, sir?
Okay. So my number 4 is where to get help. So the thing is that, like Mark and I have been doing this for a long time. We traded down in the pits in the Chicago Board Options Exchange, had long careers doing this, but we didn't just, fall out of the womb knowing how to trade options. Like, we got trained and we got help. And throughout my entire career, in fact, even now, every once in a while, like there's something where, oh, geez, I'm not really sure about this. Let me ask someone who knows, and to be fair, you should have that goal too. You should learn throughout your entire career. So it's essential to have a resource to get help, to further your knowledge, and to get the answers that you need, like to be part of a community of traders, online or otherwise, and just to know where to get answers, to have a resource lined up.
There you go. The man who's the instructor saying no one would get help for number 4. I understand why you might put that on your list, but it does make a lot of sense. That's why we do a show like this at the end of the day, to give people an outlet to find said source of help. All right, next up, my number 4. Interesting one, a little bit counterintuitive to some folks, but I do see people having issues with this when they first start trading options. Obviously, everyone comes to the well and they think, selling puts, that's super risky, and short premium, all these selling options trades are super risky, and there certainly is risk inherent in those. But I think before you start trading options, you should really understand that long premium also has some inherent risks to them. Now, they are different than the short premium. Short premium risks are usually effectively unlimited. Unless you're selling a put, then you're limited by the stock effectively going to zero. But I think by the time of your impact of your bank account, it's going to be effectively unlimited on there. Long premium risk is going to be limited in most scenarios by the amount of premium you're actually paying out there. So that's a nice thing. The risk is capped, but there still is risk. And it's a type of risk that I typically refer to as the death by 1,000 cuts type of risk. You're typically, unless you do what I talk about in number 3, I'll save that for a little bit later, but you're typically not going to see all that premium really go away in a heartbeat the way you can see it go against you almost instantaneously in a short premium type trade. You're typically not going to see that in a long premium trade. It's going to be more of a type of thing of you put on maybe a long straddle. This is where people see it all the time. This is why we say that's such a dangerous type of position to put on, because it's going to erode like crazy, and you need a big move to have that pay off. And what happens in the long premium trades is if you get the slow meandering move as opposed to the sharp move, or maybe the underlying just kind of sits around on your strike and doesn't really want to play ball, that's where this death by 1,000 cuts really starts to kick in. Of course, I'm talking about the impact of time decay and theta on that. This is the type of thing people come in, they load up on these long premium trades and think, oh man, I have no risk, or my risk is just this. Yes, your risk is just that, but the probability of a lot of that occurring and of that death by 1,000 cuts really coming into play is something that's pretty high, which is why we say you need to have those types of strategies in place and what you're going to do if, let's say, your premium erodes by a certain amount by a certain date. Maybe you want to take some of that off to live to fight another day. You want to see all your positions just erode to zero while you're waiting for whatever the heck it is in your underlying to happen. So people put on a month option. They think, I have a month for that to happen. Technically, that's true, but yet to about week 2.5 or 3, most of the juice you just bought is gone. And you need a much bigger, more aggressive move to make all that back. And you're pretty much trying to fill that hole back in. You're in the hole now rather than starting off at even. So that's something to bear in mind when you're trading options. Long premium has some inherent risks as well. They are different, but they are out there. All right, Dan, we already did your number 4. So what is your number 3, sir?
Know your brokerage platform. So this is kind of a big deal. There's a lot of things. Okay, so like I have accounts with a handful of brokers, and I will go as far as saying that none are absolutely 100% the best. Everyone has something that I wish they did a little better, and everyone has something that I love how great they do it. But every platform has a whole bunch of stuff to look at if it's an option trader friendly platform, because everybody looks at something different. There's a lot of information that needs to be at your fingertips. So whatever your trading style is, the things you look at, you should get very, very comfortable with your platform. Have your option chain set up. I, of course, always advise our traders to have the columns being implied volatility, delta, theta, vega, bid-ask, and volume and open interest is optional. Occasionally I'll throw bid size and ask size on there when needed. But, have those columns set up, know how to manipulate the charts as needed, how to throw on indicators and moving averages, know how to set up your watch list, and especially know what those numbers mean, like account value things, like what does net lick mean? What does unsettled cash mean? What is available funds for trading mean relative to cash and sweep vehicle? Like what do these words mean? And get rid of the stuff you don't need to see. Keep the stuff that you do need to see. But, make sure you're not confusing yourself and make sure that, you don't see some number go totally out of whack and think, oh, my God, what happened? Did I just lose a bunch of money? So just know the things you need to know. Don't worry about having to master every single thing in your platform. Real robust platforms like Thinkorswim, for example, like there's a million bells and whistles. I don't know how to use them all, but I know where to get the things that I need to get to, and I've got it down pat so I'm not struggling when I'm trying to trade and make money.
Probably could do a whole show on just understanding what that options buying power number is and how that calculation is done, because it's going to vary, obviously, depending on your broker and your account type and everything else like that. But that probably, in and of itself, Dan, is worthy of some future exploration. But you're right. Knowing whatever platform, we're not recommending a platform. There's a bunch of different ones that have their own unique strengths and weaknesses. Whichever one you do use, make sure you are at least familiar with the functions you need to know and need to use. If you're a go-to covered call guy, make sure you know how to get those off on your platform of choice and analyze the risk and everything else that you're doing over there. Well done, Mr. Dan. I'll go to number 3 now. My number 3 has a variety of different titles for it. You can maybe title it Event Risk. Maybe you could title it To the Impact of Volatility Skew. We can call it a number of different things. But I wanted to make sure I got this in my top 5 because this is certainly something that really seems to impact new options traders the most. And it typically is around this time. It's around earnings season that we see this impact felt the most and perhaps the most dire. And we talked about it before here on the show, this new wave of people coming through on these new brokerage platforms. What are a lot of them doing? They're going out and they're loading up on their upside calls in their favorite stocks. Usually it's your Apples and your Teslas and some of the FANG names out there pretty much. And a lot of times they're doing it right before earnings. And so that's why I put this tab in here number 3 for event risk, because we've talked about it before. Trading around earnings is a very difficult thing to do repeatedly and reliably, and it really takes a little bit of sophistication and knowledge of the option space and indeed of the particular underlying that you're trading and how it's performed in the past and what some typical cycles are for it around earnings. We offer a lot of that data actually for free over there at theoptionsinsider.com. So if you want to research the earnings volatility history of a particular name, head on over to our website, go to the Options News and Articles tab, and then search for the Options Move results and earnings season reports, courtesy of our friends over there at Oratsland. You probably find the ticker you're looking for, and you can see how it's performed in the past. That will help you at least have a more informed perspective on perhaps what to expect going forward. But all this stuff, it could be an earnings announcement, could be a conference call, it could be anything out there that really falls into the category of event risk. The election coming up in about a week here in the U.S. could certainly be argued as an earnings type risk or event risk for the market as a whole. So what happens in all of these types of events is you're going to see this inflated level of premium, inflated level of volatility going into the event itself. And then, of course, once the event happens, unless there's some extreme surprise in one direction or the other, I've often used the analogy of that it's a balloon. This balloon has been filled up with all this event premium, all this event juice. And once the event happens, again, unless it's some crazy surprise in one direction or the other, they stick a pin in that balloon and it pops. And what happens is that explosion of all the earnings event premium going away, it catches up so many of these new retail options traders who just wanted to buy a call on a name they liked or something like that and thought it was a great deal and had really no knowledge of what level of volatility they were buying, or maybe the fact that maybe they should avoid earnings season altogether when they're just starting out as an options trader, or so many other caveats that go into that. So before you dive into options, if you're one of those many, I know there's a lot of you out there who are thinking about, I want to try these things around earnings. That's probably maybe not a good place to start. It's a difficult way to proceed. We have talked about it in the past. Maybe we'll do another show about maybe the best starting point for an options trader to get started in terms of a trade or a strategy or things like that. But in general, particularly for the listeners of this show, particularly if you're just starting out, you're coming through one of these new platforms, be cognizant of event risk and how it's impacting the underlying that you're trading. One way to study this really quickly is to go look at whatever platform you're using. Hopefully they have this tool available for you. It's a thing called a volatility cone. You can go look at the historical levels of implied volatility, what that's been priced in the past, and where it's trading now. So you can look and see just really quickly, if you're one or two standard deviations above the mean there for level of implied volatility, maybe you should be cautious buying that, and vice versa on the dark side if you want to sell it. So that's just a very basic thing you could do to help avoid this. Obviously, also be cognizant of the events calendar. Know when your earnings announcement is coming up. That's another good thing to do. But in general, if you're just looking to get started in options, this is probably an area you probably want to avoid to get a little bit more miles under you from an options perspective. All right, Dan, what is your numero dos, sir?
Well, Mark, it is know your Greeks.
I'm stunned. I'm appalled that you would have the Greeks on your list, sir. I can't believe it.
Well, yeah. See, that is the thing. What's the analogy I use all the time? I know our long-term listeners will know the Greeks are like the dashboard on your car. Can you drive your car without looking at the gauges on your dashboard? Sure. You know, you might run out of gas, you might get a speeding ticket, your engine might overheat, but you can do it. It's just not a really great idea. You know, the Greeks, like, there's so much information packed into them that you can't get anywhere else. Like, it is like the single thing. Like, you need to know that stuff. And so, yeah, it's really, really important. The Greeks will help you get into trades better, analyze trades better, have a more precise entry point, exit your trades better, adjust your trades better. Like, people who know the Greeks back and forth, like the back of their hand, like, they trade better than people who don't. And it's just plain that simple.
Dan, it is kind of interesting how you and I got very simpatico here at the top of our list. I actually, as a tip of the cap to you, I made the Greeks number one because I figured you would as well. So Greeks are actually number one on my list. I figured Dan's going to put them at the top of his list. I got to have them there for me as well. But I definitely concur. I like your analogy of the dashboard of your car, but you really can't get started using these things if you don't understand the Greeks. We had some people on in the past, and people have argued, if you're just coming in, you understand the break-even graphs of options, you understand how much you pay, where the underlying has to move to break even, that sort of thing. The Greeks are kind of meaningless, but I really think if you're going to be doing this and you're listening to a show like this, or you probably want to take your options a little bit more seriously, then you have to understand it. You have to understand your delta and what it means for your directional exposure. You have to understand your gamma. That's where people sometimes get really confused. But gamma, that rate of change of delta, also very important. Of course, theta. We were just talking about it earlier. There, how it can impact your trading. And the big dog Vega out there. A lot of retail traders only think of things in directional terms. They really only focus through delta and then maybe, as a result, also a little bit of theta. But they forget about Vega. That's definitely a key mistake. You want to pay attention to the Vega. Again, if you're paying a ton of Vega in your options, or if you're selling a very low level of volatility in a particular name and you want more volatility exposure, these are things you have to be cognizant of. How much volatility exposure is actually baked in to your options out there. So these are all good things. That's why I put the Greeks at number 1. So Dan, that's my number 1. I guess I'll do my number 2 later. What is your number 1, sir?
Well, in addition to the Greeks, it's know your risk profile. So I break down the analysis of options risk, and by risk I mean opportunity for profit and potential for loss. Either way, just sensitivity is a better word, I guess. But I break down how to analyze your option position sensitivity in 2 ways. One is incremental risk, like the Greeks, like, hey, when a day passes, how much do I make or lose? If volatility changes, how much do I make or lose? The stock goes up a couple pennies or dime or $5, whatever, how much do I make or lose? That's your Greeks. But I also like to just know big picture, like worst and best case scenario. What's the worst thing that can happen? What's the best thing that can happen? And we get that from profit and loss diagrams, the good old fashioned at expiration profit and loss diagrams. Now, I encourage people to learn how to draw them on a piece of paper with a pencil, especially when you're first learning. And if you do that enough times, you draw 100 of those out over a month or so, you can do it in your head, no problem. I advise people never to hold positions until expiration, but every once in a while, if there's a big, gigantic move that's highly unexpected, black swan event, you can hit your maximum loss or you can hit your maximum profit. And you want to know what that is, because when that happens, that could be really, really good or really, really bad. And it's really, really important to know that.
Once again, you and I are simpatico on the top of our list here. It's like we've been doing the show together or something for a while here, Dan, because I had as my number 2 effectively something analogous to what you were just saying. I put it down under understanding your synthetics, which is effectively know your risk profile, which is effectively what you were just talking about. This comes under, the rubric of many different things. The most common and most frequently cited one, of course, is you go to a room full of new options traders and you say, how many of you will sell covered calls? And they all raise their hand. Oh, that's great. We love it. Then we say, how many of you also will sell puts and naked short puts? And all the hands go down. And you ask them why. And they say, oh, that's crazy risky. And that obviously is an issue with not understanding your synthetics, not understanding the true risk profile of your position. And that, of course, the short put and the covered call, effectively the exact same position from a risk equivalency, a risk profile perspective. So understand your synthetics, how they line up on the strikes, things like put call parity. That's also a useful thing to know. The price of one option implies a value or a price for the other option and vice versa there on that strike. So these are just some basic fundamental relationships of options that you need to know, you need to understand. So you don't go out there and put on a trade without really understanding all of the inherent risks or issues with it. So there you go. Those are our top 5. Well, 5 in my case, 4 plus for Mr. Dan. Things you need to know and or understand before you start trading options. All right, Mr. P, unfortunately, we've come to the end of this epic journey through the world of options bootcamp. But before we go, if folks are intrigued, maybe they want to reach out to you to ask you more about some of the items on your list, or they have other types of questions, where should they go? What should they do, sir?
Yeah. Hey, I love talking to our listeners. I love nothing more than talking to our listeners. And you can always reach me at our website, markettaker.com. That's market, like stock market, taker, like take what is rightfully yours, 2 T's in a row. Markettaker.com. And you can contact us there. You can get a complimentary membership there. You can inquire about one-on-one coaching there. Anything that you feel we might be able to help you with, we will do our best to do so.
There you go. Check it out, markettaker.com. Don't forget to put on the second T for theta, markettaker.com. And on behalf of the black-headed one and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live. If you're listening live, you get a little extra bonus. You get to hear the next episode right now. Otherwise, we'll see you back here next week for another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.